The market is rallying today, at least stocks are, on word a partial China trade deal could still happen. Is this wishful thinking, or do we need to price in a long-term standoff? Joining me now are Paul Christopher, who's head of global market strategy at Wells Fargo Investment Institute, and Charlie Bobrinskoy is vice chairman of Ariel Investments. Guys, good to see you. Charlie, I'll just begin with you. And, it was suggested earlier in the week by Dan Clifton that if we're in a longer-term standoff with China, market multiples need to come down. That's what happened during the Cold War with the Soviets, for example. I mean, what are the ways to think through the longer-term implications of everything that's playing out here?
I think it's always important in one of these situations to try and figure out what the market is pricing in and then compare possible outcomes to that. And I think right now, the institutional investors that I talk to, the commentators that I hear on your show are pretty bearish. And they're forecasting a recession. They're forecasting continued trade tensions. And I think that's factored in. And so when you get just a little bit of good news, like we got today, you get a couple 100-point rally in the market. I think if we get a substantive agreement that's just better than where we were, with some intellectual property protections, with some reductions on the need for partnerships, with a little bit of extra agricultural purchases. And don't poo-poo that, Kelly. There are a lot of soybean growers in Iowa and important states in the Midwest. But
is $10 billion going to make a difference to them, Charlie? I mean, our support for them was $16 billion, so I understand that that's some chunk of it. But I also just wonder if it's telling us the Chinese need access to that product as opposed to really giving us something.
I think that's a negotiating point. I think they know that how important farmers are to Trump, and they think that they can, quote unquote, buy a little bit of support and take some pressure off him for that. So the point of all this is I think there's a lot of bad news baked into the market. And if we get some kind of progress, I think we could get massive move up in the market.
OK, Paul, what about you? Do you agree that that seems to be the stance that everybody's kind of braced for these bad outcomes here?
Yeah, we agree that there hasn't been really any optimism priced in for months on the U.S. China trade dispute. And if you do get some sort of deal, you are likely to see a positive market reaction. But we don't see how you can get anything but the skinniest of deals out of this. As you pointed out, $10 billion in soybeans is not much. They could still buy through the Brazilians. And frankly, if they just got the U.S. to withhold the October and December tariffs, that's not that big a deal. Those could always come back on. Remember, the president has imposed all the tariffs that he's threatened so far. We think there are much bigger rocks to break up here, and you're not going to get that the deal on partnerships. You're not going to get that deal on intellectual property.
Very quickly, Paul, your top three places to be in this market.
So we still like cyclicals here. We think you still have more growth, information technology, consumer discretionary, and financials.
And Charlie?
Small and mid-cap value stocks. The Ariel Fund, our flagship, trading last night at less than 12 times forward earnings. Very good opportunities in small and mid-cap value.
You are a brave man. All right, guys, thank you both. Appreciate it. Paul Christopher and Charles Bobrinskoy joining me today.